All right, guys, I'm back now. Sorry, I was creating this broadcast for yesterday, so the picture is a little bit out of date. So that's why it says June 18. I'm assuming. But anyway, so today I'm not gonna look at the comments, so I'm so sorry about that. If you are commenting, I will see it later though. So I don't know how many people are gonna stop by, but thank you. Welcome back. So today it's just one of those days where I was kind of reflecting on people were saying like dilution is bad, da, 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 and it's like not really looking at. I wonder if they look at the number. So let's look at the number together, and I did some spreadsheet here. I was kind of like thinking about okay, what else should I be talking about? But I don't have anything, so nothing much. Of course, if you want to look at the um price point real quick. Of course, you know what is being traded at today. Of course, people are talking about the XRT issue thing where it was on the FTD security watch list of failure to deliver, rec show, whatever the rule is. Of course, those are, market mechanic that has nothing to do with the company. So, I mean, while it is important for some people who are trading the stock, it's not much important for me if, of course, I'm looking for a run as well. But hey, it is what it is, right? Now, this morning I was able to add uh, uh, one more call to my portfolio, and I bought it at 20 strike price uh, end at August, and I was able to get it at $600 or so, 630, I think, 635. And I did a market order. I was trying to grab it at 6, but wasn't able to be lucky enough. But yeah, that call immediately end of the day went up $100 per contract. But I did a kind of um, sell a short dated covered call to kind of like take advantage of the um, kind of not. I don't want to lose that call yet because it still have the intrinsic value to that call, but remain to be seen. So I'm not imagining that it's gonna close above 30, but tomorrow, if it gaps up a little bit, I might spend some money to kind of close out that one because I don't want to lose my call, right? And the ability to exercise at $20. Um, just keep in mind my average cost is around 28 for that. If I were to exercise it at $20, which is $28. I mean, yeah, $28 is not too bad for me to get the share of GME. But I just want to see if the call option would enable me to get that quick profit here. And of course, I'm going to convert it to shares anyways. It's not much there. Okay, so that was just me explaining the pool man covered call. I mean, I'm sure you could learn about that elsewhere if you want to learn about it. So that's what I was doing this morning. Again, just one call, one more contract here. Um, okay, so let's look at the topic at hand. But before that, of course, it's worth revisiting. You know, right here, revenue, gross profit, right? So you see the trending down, like people are pointing that out. It's like as if it's like a broken record, right? Of this company. But also, people don't really understand that, okay, well, at least something else is also trending down, meaning it's a good thing for this particular thing to trend down. So eventually we're going to be able to reach equilibrium. Quarter two, we want it to be a positive, and keep in mind too, if we were to be able to come out positive in the next quarter, perhaps we would be able to kind of tick off that one box of S&P 500 again, right? We want three consecutive quarter in a year. So no matter which one, whether it's quarter two, three, four, um, trending up in the right direction where we are going to be in the plus for the rest of the quarter, that is going to be kind of something to wait for in terms of the company, right? Or well-being. And of course, we have the confirmation already that because of that marketable security that we had sold into the float, we are able to kind of generate the positive earnings already. So it's a done deal in a sense. Because again, if we need the 3 consecutive quarters to be positive to be in the S&P 500, that's again, it's going to aid GME to be in that realm of possibility, even closer, right? Okay, so let's take a look at this one right here where I have the slide. Of course, I'm sure you guys have seen this before if you watch my channel before. Again, this is the dilution, quote unquote, right? The first one we were able to sell it at $20 or so, and then the second one is average at $28. All of which is going to increase the book value by this much right here, and this is the multiple 4 times its book value, and then 4 times coming from 6 point, yeah, the first dilution. So technically, if you were to do book value from here to here, that is going to be the 2 times its book value. All right, so I'm sure you would know who this one I'm referring to. Of course, it's Roy Kitty position. So let's take a look at his position real quick over here. Of course, this is a ballpark. Don't quote me on this. I just saw it briefly and I just put it all together here. But the idea and the concept is still the same. So just substitute the number and then you see it play out here. So let me try to explain what I'm doing here. Now, before the dilution, right, we saw that the Roaring Kitty was amassing 5 million shares. So assuming that 5 million shares stuck there and he never add anything, don't worry about the call option yet. So I'll count that later on. So for that 5 million shares of GameStop at $21 ish per share, you're gonna have, let's try to figure out, okay, the percentage ownership for the company, right? So at face value, if you were to, again, this is before dilution, this is after dilution. And so before dilution, right here, 1.4%, right? After dilution, the same 5 million shares, higher float, he was kind of like diminishing in percentage of ownership, right? Of course, this is what that guy, Ross Cameron, day trader, was pointing out. It's like, hey, you're getting diluted. Oh my God, it's so bad, right? Okay, is it really? But look at it. So again, book value. This is what Morantz was, you know, telling the audience. Look at this: 4 versus 10, right? Even for that. Now, let's take an account for this one right here. Yes, you own more percentage of the company, but look at off of what? 1% off of $1.3 billion. Would you rather 1% off of 1.2, 1.3, or 1% or a little bit less of a percentage from 4 billion? So if you were to run that number right there, that portion that you own from the before dilution is $18 million worth. But after the dilution, it's $52 million. So technically, your dollar amount increased, even though the portion that you own of a piece of the company is lower. Now, you could look at this way as well. It's like you could say, oh well, leadership has killed the squeeze already and kind of forced our hand to sell it at $28 a share, right? Or on average, if you were to average these two, around 25. So, a little bit more than 25 actually, because the amount here is higher, right? So technically, leadership has forced our hand to take profit at $28 a share. I mean, that's the only negative connotation to the whole dilution is, but as far as like the value of the company, you get a better value for the share that you own. Yes, it's smaller in portion. Okay. So, and if you were to look at the same concept here, like if you could go through the number, like the 4 million shares that he was exercising, right? Because when he bought that call, it was before dilution. Again, like you could account it like even now. If you were to buy it at $80, it's the same exact, dynamic here. So there's no dilution per se. Like, yes, if you're a newcomer to this company, obviously it depends on what price point you got in. If you got it at $80, for example, you might, get the company at a higher valuation than people who got it at $10, right? Or $25 or $21, right? And so again, cost average is very important. This is why dollar cost averaging down is never, you know, never a bad thing to do. Okay, so I hope I kind of explain everything. I know I'm kind of rushed today for for whatever reason. Um, but yeah, I just want to kind of come out here and kind of live real quick. I don't want to do like pre-recorded video. Kind of lazy to upload a little bit here, but not much here. But again, so the moral of the story is, let me kind of summarize it a little bit here. The moral of the story is the company is doing better, right? And the company has more cash for you to, enjoy from years to come. Okay. And again, know what players are you, in terms of like, remember I told you about the casino, right? Do you want to be a dealer? Do you want to be a facilitator or facility that, provide a place for people to gamble? uh, or you want to be the gamblers. Now, whichever one participation that you think that you are good at, do it. Participate. Come and participate in this company. But just so GameStop is equated to the facility, meaning without the facility to gamble, you wouldn't be able to interact with the casino in that sense, right? The casino, you need the place, you need the people, you need the network of people who will interact with that type of thing. I know it's terrible to equate GameStop as a business to be a casino, but that's just how the dynamic of the stock market is. Some people are going to lose money, some people are going to win, but I think shareholders going to win big on this one if you want to be long-term shareholder. So, hey, just my perspective here. If you don't like that, I'm sorry, but again, fact is fact. You cannot deny that the fact that GME is doing better as a company, having more cash, and just like Ryan Cohen was saying in the meeting, that he's here for long term. He's not here to hype anything, and he's using his time and energy without getting any pay to do so. So, hey, somebody has to support him, right? These type of people you cannot ignore. At the very least, watch what they do. That's what I think. All right, you guys, this is all what I have. Sorry, I'm kind of rushed.